the same kinds of controversy. So I wanted to take you a little bit through the macros, what the Trump administration says it wants versus what might likely happen given that backdrop, as well as how this clarity is going to impact the world of innovation, the world of transformative innovation. And we believe the world is transforming and in miraculous ways. So we want to take you through some of that and how this administration, its policies are probably going to accelerate these changes.
Tom Lee compares the current investment landscape to the early 1980s under Reagan, noting similarities in economic challenges like deficits and high interest rate. He highlights how policies like tax cuts and reduced interest rates then spurred growth and predicts that similar strategies now could drive innovation in technologies such as AI, energy storage, and blockchain. Lee emphasizes that productivity growth from innovation will counter inflation and lead to lower commodity prices and interest rate. While initial caution may delay activities, he expects transformative technologies to drive strong economic and productivity growth, fostering deflationary benefit. He also critiques current regulatory hurdles, particularly in digital assets, but is optimistic about upcoming changes in agencies like the SEC and FTC. Lee stresses the importance of aligning with transformative technologies as they unlock significant investment and business opportunities.
Greetings, everyone. Well, we have more clarity now in terms of the investment landscape after the election. And I wanted to talk a little bit about deja vu for me. I started my career really in the early 80s. And at the time, we had the Reagan administration and a lot of controversy about everything, much of which we're hearing today. The way inflation will stay under control is productivity growth, and we're already seeing strong productivity growth thanks to artificial intelligence and other new technologies, as well as actually the dollar firming. Most commodity prices are priced in dollars. Most commodities are priced in dollars, I should say. And the dollar going up means downward pressure on commodity prices. That's a very good thing as well. So what will happen to interest rates here? Now, this is a little different from the 80s. Interest rates were so high at the beginning of the 80s, 15%, that really, if the Reagan administration got anything right, those interest rates would come down. And they certainly have. Now, 45 years later, they are high relative to recent history, 5% on the Fed funds rate. And they are restrictive relative to where we see inflation going. So we do believe there will be a downward pressure on interest rates, maybe even more than many investors expect in the near term, because I think a lot of activity is going to be held back by a desire to understand how policies are going to change in the future. If we believe tax rates are going to come down, we're probably going to wait. If we're businesses and consumers, this is classic. It even happened during the Reagan administration when he phased in tax cuts over 3 years. Most people just waited until the tax rates were at the point he had promised. So we probably will see some holding back of activity in the next year in anticipation of even lower tax rates. So I think interest rates will be biased to the downside. Thereafter, I think we're going to see an explosion in productivity growth. That's what the convergence among the major innovation platforms around which we've centered our research. So robotics, energy storage, artificial intelligence, blockchain technology, and multi-omic sequencing in the healthcare space. Those platforms are converging and we believe are going to unlock explosive productivity growth, explosive GDP growth, and much lower than expected inflation because all of these platforms are deflationary. They're technologically enabled, and that's good deflation. As prices fall, units explode, and it's really important. The reason we give our research away, it's important for investors and individuals and businesses to get on the right side of change because these are transformative technologies. So in terms of government policies, perhaps the most profound thing that's going to happen in the very near term is a changing of the guard at some of the regulatory agencies. The SEC and the FTC. The SEC menace to the digital assets movement. We've lost a lot of talent to other countries because of Chairman Gensler. And I think that's going to change. We know it's going to change. So let's talk about macros first. In the early days of the Reagan administration, there were back-to-back recessions and interest rates hit 15%. And that was a very difficult environment for investing. Well, President Trump is coming into office when that part of the equivalent in the Reagan administration has been done. And I remember after that, the 80s and 90s were the golden age of active equity investing. And I think we're going back there. First of all, in terms of the controversy, a deficit back then, after back-to-back recessions, 5.5%. The bond market was apoplectic about that. Investors were as well. And what they didn't understand is that the Reagan policies of tax cuts, along with lower interest rates caused by Volcker, moving from double-digit interest rates to something much lower, that those were going to be very positive for economic growth, and that we were going to grow our way out of the deficit. That growth out of the deficit started in the 80s with the Reagan administration and finished in the 90s with the Clinton administration, taking us into a surplus. We think we're going to experience somewhat of the same thing this time around. The tax cuts, we believe, are critically important, especially if Trump makes good on his tariff promise. Now, I'm not a big fan of tariffs myself, but if we're going to pair tariffs, not on our free trade partners, but on those countries that really are not giving American goods and services a level playing field, but we counter them at home with lower tax rates for consumers and businesses, that's a trade-off. That's a good trade-off. And so I don't think the criticism about tariffs is going to play out in terms of 100% across the board. That's not what we're talking about here. I think President Trump is very pro-growth, and he's not going to do anything to impede growth in that way. He wants the dollar down. He thinks that will make us more competitive. What I think will happen is the returns on invested capital in the United States relative to those elsewhere in the world, they're going to increase, and that is going to attract more capital, which will actually boost the dollar. Now, in terms of interest rates, the dollar going up is anti-inflationary, as is the productivity growth associated with a burst in activity caused by lower tax rates and other incentives for investing. So if inflation is going to surprise on the low side of expectations, that's going to be very good for innovation-driven strategies. What happened during the last 4 years, actually, is the burst of inflation caused by many things, but COVID, supply chain, money growth exploding. Even though the Fed has gotten all of that under control, I think a lot of investors have had trouble believing that it would stay under control.
Tom Lee compares today's economic landscape to the early 1980s, highlighting how policies like tax cuts and innovation in areas like AI and blockchain could drive growth, productivity, and lower inflation. He predicts regulatory changes will further support these advancements, creating significant economic opportunities despite short-term uncertainties. Lee stresses the need for businesses and investors to align with transformative technologies as they reshape industries. He remains optimistic about the potential for innovation-driven growth and the positive impact of supportive policies. How can businesses adapt to capitalize on emerging technologies? What steps can policymakers take to support innovation while ensuring stability?